So we've just finished the panel on bank finance, and now we are still on the topic of finance, but now this panel is on project and alternative finance. Project and alternative finance is a particularly robust activity in Norway, financing Norwegian projects as well as projects all over the world. I'm Nicolas of Capital Link. I would like to thank Keith Billotti, the partner of Seward and Kissel, who is going to moderate this panel. And I would like to thank, I would let Keith introduce the panelists. I'd like to thank you all for joining this very important panel and making our forum a great success. Thank you very, very much.
Thank you, Nicolas. Very happy to be back here in Norway, even if it is on Zoom. You know, with any bit of luck, hopefully we'll be back in person quite soon. We have a very interesting panel for you here today with a lot to cover, so let's jump right into it. Alternative finance is a really broad and ambiguous term. You know, it generally means transactions other than traditional debt and equity financing. You know, at this point, it's really become a misnomer as it's become quite mainstream. It's a very competitive form of financing, and it's on the balance sheet of many, many shipping companies. At this point, I want to turn it over to our panelists. You know, I'd like to give them an opportunity for each of them to give themselves an introduction, tell us about themselves, and if they could discuss their platforms and the solutions that they provide and the access, you know, and how they access alternative financing. So with that, I'll start off with Aksel, the CFO of SFL.
As told, I'm the CFO of SFL Corporation, as we are called. We have been listed on the New York Stock Exchange since 2004. And today we have a fleet of approximately 80 plus vessels. And in terms of our fleet, I mean, since inception, we started with a fleet of only about 40 plus crude tankers on bareboat charters to one client. We have a diversified fleet. Liner segment is by far the largest in terms of revenue. We have a diversified portfolio of clients, and I would say it's been migrating from bareboat charters to looking at the first quarter of 2021, we had more than 80% of the revenue coming from time charter vessels. So in a way, we have, call it perhaps, moved away from being kind of a pure provider of alternative financing and becoming more of a kind of ship on with long-term charters, but yet a very financial hat, but kind of taking advantage of being part of the Sea Tankers group of companies and the setup we have. So if you look on how today, I think it's twofold. We use it as a part of our capital structure. For each project we do, we try to tailor make the financing attached to it. So depending on the tenor, maybe I think majority still call it first lien bank financing from kind of our good banks, but also if we especially look at long dated charters, 7 to call it almost 12 or 13 years. I mean, we find Japanese or Chinese leasing alternatives to be very attractive, given the long dated tenors and fixed margins, really. So that's the one way we use alternative finance. But in some cases, we also do bareboat charters, like over the last few years, we did some deals with the Hunter Group. We provided more flexibility than they could achieve in the bank market. And that's also something we're looking at for the time being. So basically, we tip our toes in both worlds, both as kind of a user of alternative financing, but also a provider of alternative financing.
Yeah, William, can you give us a little introduction on yourself and solo shipping and the solutions you provide in this space?
Yeah, sure. My name is William Denstad. I'm 54. I've been in the shipping finance industry since 1994. First 11 years with DVB and previously that Nedship Bank, and started Soul Shipping in 2004. We have done one strategy since the beginning, and that's sale and leaseback transactions on bareboat basis, typically 5 to 7 years. and typically including a seller's credit, 10 to 30%, and always including call put structures. And we have done, some 50 ships since we started. Currently have 40 ships in the portfolio, all different types of ships, really. We focus first of all on the counterparty, that they have a system in place and financially robust. And then secondly, we look to what type of ships are involved, but obviously making sure we buy at a relatively low point in the cycle, definitely not high price. So we have invested, roughly $1.1 billion in ships, and we have raised $450 million of equity, of which we have roughly 120 million left for new investments in the next year or two. So we are actively doing deals at the moment. We have bought dry bulk and tankers lately, and we are looking at several transactions at the moment, and we have worldwide cover.
Thank you. Nicolas Duran, the head of debt advisory at Fearnley Securities. Nicolas, maybe you could speak a little bit to the solutions that Fearnley's and yourself provide in the alternative finance space.
Absolutely, thanks. So we are part of the Astrup Fearnley Group. We're the investment banking arm of the group. We've been around since the mid-'80s, roughly, as the investment bank specialized towards energy in the maritime industry. We quite recently merged all debt products into one team, which is the team that I now head. So that includes bonds, direct lending, leasing, etc. And I think that reflects our approach to the business. We see debt as very much a complex and bespoke product. Many debt products could be applicable or relevant to the same project or task that needs to be solved. And so I think that what we try to do is look at our clients' needs and come up with both the best structure and best source of capital to match those needs and solve their what needs to be solved and addressed. So we have in our team about just on debt advisory, 8 people, 1 in New York, 6 here in Oslo, and 1 in Tokyo as well on part of the business. And so we recently have been quite busy on the bond side. We've done 3 shipping bonds this year, totaling, I think it's $800 million. And in addition to that, we always are relatively active in the leasing space with everything from sort of cruise vessels down to 10-year-old bulk carriers and everything in between. So we really cover the entire asset universe, and then also the different debt products. So that's us.
Super, thank you. Christian Dechsling is the head of project finance at NRP. Christian, can you tell us a little bit about NRP and what you folks have been advising on and the solutions you provide?
Absolutely, that I can do. So firstly, NRP is an investment boutique sitting here in Norway. It was established about 20 years ago, and we focus on 2 different sectors, one being the Nordic real estate market, and the other one being shipping and offshore worldwide. So historically, NRP has been, I would say, an arranger of these, what we call the KS system here in Norway. Today, we have about 46 vessels under management under these structures, some of that being, say, leasebacks and others being more asset plays within all different sectors, tankers, dry bulk, containers, car carriers, MPPs, even reefers, actually. And in addition to that, we also have an advisory department where we advise different ship owners obtaining different types of financing. That could be different types of, say, leasebacks or other direct lending products, as well as regular bank financing, actually. And in addition to that, we also have an asset management arm they manage today on the shipping side an equity fund on the shipping side who do co-invest with different owners in different vessels. And they are also in the process of setting up a new credit fund who's going to offer non-recourse financing to smaller to medium owners focusing on the assets. So I guess that's a short introduction of what we do here in NRP.
Thank you very much. And last but definitely not least is Andreas Roede, the head of business development and M&A at Ocean Yield. Andreas, can you tell us a little bit about Ocean Yield and what you guys are working on?
I can. Thank you, Keith. Well, Ocean Yield, we're a maritime financing provider. I would say the majority of our business is providing long-term flexible financing. Relative to SFL, like Aksel mentioned, we do the majority of our business on a bareboat basis, i.e. we're a financing provider as such. The majority of our deals are 10 to 15 years, so it's longer dated sort of financing, similar to what you would get in Japan or China. We have a fleet today of just shy of 70 vessels, and average age is just below 5 years. So the majority of our focus has really been on modern tonnage. We have around $3 billion of backlog on the EBITDA basis today, and the average duration of our portfolio today is around 10 years or so. So, you know, providing long-term visible cash flows both to our investors, and dividends has been an important part of our story to the equity markets and will continue to be so. We've paid out, you know, just shy of $700 million in dividends since our IPO in 2013, and the stock is currently sort of yielding, you know, around the 6.5% to 7% mark on an annualized basis. We're fortunate that we have unique access to financing banks that are, you know, seeing the merits of a diversified model such as Ocean Yield, and we're currently lending from around 20 well-recognized banks across the world. And we've also been utilizing the Norwegian bond market with great success to optimize our capital structure. We're part of the Aker ecosystem, which Aker is a industrial conglomerate in Norway, controlled by a Norwegian entrepreneur called Kjell Inge Røkke, and Aker remains our main shareholder, controlling just above 60% of our share capital. In terms of our business and sort of where we're active at the moment, I think that if you look at our fleet, the majority of what we've done the last couple of years have been in what we refer to as sort of commoditized shipping, so tankers and bulkers. But we also have, as SFL, a substantial part of our portfolio on the container side, and we also have you know, investments in gas carriers, car carriers, and a smaller piece of our business in oil service. I think that's a brief intro to what we do.
Terrific. Thank you so much. You know, we're at a unique and very interesting time in our history right now. We're emerging from a pandemic. There's tons of government stimulus. We have rising commodity prices. There's an uptick in share prices. Given this backdrop, given where we are in the markets right now, you know, what sort of trends are we seeing in the alternative finance space? What types of deals are receiving the most attention in this market and gaining the most traction? I'll start with you, Jan William.
Yeah, I mean, all the things that you say is a little bit worrying for us because basically everything you say is going to drive the asset values up, which takes us into more dangerous territory in order to invest in new tonnage. But we have been lucky to have done several more traditional dry bulk and tanker deals so far this year. And we will continue to do that. We will look at conventional tonnage, but also specialized tonnage. Obviously, with these trends, underlying contracts will play a more important role, as well as the level of the seller's credit, because we will not buy at inflated prices. But I think that many ship owners around the world is now very eager to both renew their fleets, but also expand the fleet, because if you disregard containers, and some of the dry bulk sectors, but in other sectors, the asset prices are still attractive. So we actually see a lot of demand for new requests, basically owners looking for sale and leaseback transactions in order to free up capital to invest more.
Thank you. Nicolas, do you agree with that? Do you have anything to add? What trends are you seeing in the market?
Yeah, I think that I agree with all the comments you made initially on what we've seen changing in terms of, you know, buoyant rates and coming out of a pandemic, increasing commodity prices. And what I think that's done is, first of all, drive the general sentiment towards shipping for the first time in quite a long while into the positive territory. We've obviously seen that in equities pricing up in the shipping space or across the maritime space. We also think the ban, maybe this is a bit not conflicting, but challenging Jan William's view. We see that the banks are really turning around here on their previous position of being very cautious on shipping and preferably reducing their exposure. So we've seen a number of banks turning 180. You know, we have clients that we've been working on mandates with for high leverage lease financing, and sort of 5 to 12, literally in the last couple of months, they've pulled the plug and said, look, we're really sorry, but asset values are up. We can now get close to the same finance amount at, you know, L plus 200. The numbers we were talking just a few months earlier were totally different. And we'd rather take that money. And companies like those didn't really get that kind of attention from the banks or from the traditional lenders previously. So I think this supports our view that leasing in particular and a lot of alternative finance products are more a counter-cyclical product. And I think it served Jan William and Andreas and Aksel really well that there's been a huge demand for their product when shipping markets have not been so buoyant. But I do believe that we'll see the capital markets on both the equity side and debt side, in addition to the traditional lenders, take sort of the lion's share of new business. And I think alternative finance products will go back to being a bit more of a specialized niche product in the next 1 to 2 years, at least for as long as the general sentiment around shipping is strongly positive, which is where this is headed at the moment. So, you know, luckily we're also quite heavily involved in bonds. So I think that there's probably going to be a number of new bond issuances, and you know, most shipping companies today, with the exception of tanker companies, could probably raise equity. Not that I think there's room for a lot of new shipping companies in the public market, but you know, I think they'll take the lion's share. So for us, we're going to continue working on our sort of staple products, but I really do see alternative finance being a bit more of a niche and specialized product going forward, and not as mainstay as it was.
Jan William, did you have something?
Yeah, I just wanted a quick comment, and I think Nicolas is perhaps right when it comes to the top 5%, maybe top 10% ship owners worldwide. But there's still 90% left of ship owners who is not in a position to use bonds or use the stock exchange and have all the banks running after them. So I still keep my view that there is a strong demand for, let's say, not the top 5-10%, but the ones below.
So Aksel, Andreas, go ahead, Nicolas.
No, I just said that's a totally fair comment. Obviously, we can't be everything for everyone, so we don't cover the entire market, but it is definitely a fair comment from Jan William.
Now, Aksel, Andreas, as owners of diversified fleets, you know, sitting in a position of well-capitalized companies, you know, do you agree with Nicolas's position that you'll be accessing the bond markets and the equity capital markets to fund, you know, new growth, or do you see a spot in your portfolios for, you know, for alternative financing? And I'll start with Aksel on that.
Yeah. I think, you know, for us, this is a win-win. You know, you see a cyclical shift. There's a lot of attention from investors in the shipping space. I think, for both listed companies like Olesen and ourselves, that is of course very positive. Investors suddenly want to have meetings, they want to get into the sector. Also the positive attention from the bond market. I mean, we just issued our first sustainability linked bond last month, very well received. So this overall sentiment is positive for us. But again, always historically when you have periods with a lot of call it capital coming into the sector, of course competition becomes fierce and often that capital is mispriced. So you just have to be perhaps a bit more cautious and selective in terms of your investments, of course. But I think for us on the marginal, we believe this is very positive.
Andreas?
Yeah, no, I think first and foremost, when we had this panel, I think a year and a half ago, we were sort of joking about the fact and making shipping great again. And I think that, we've now, thankfully, in a period where the majority of our customers and majority of owners are making healthy profits, except maybe tankers, but tankers sort of came into this whole COVID era and period with a very strong market and the backdrop. So they sort of made money coming into this. I agree with Nicolas. I mean, as the markets have turned and people have started to make money, the banks have definitely sort of altered their appetite and interest. I also agree with Aksel that, as asset prices start to rise, you need to be sort of continuously selective and careful to avoid sort of buying in at the peak of the market. One thing that's sort of worth mentioning is the fact that, there has been an increasing degree of new build activity, both on the back of sort of increasing demand, but also on the back of increasing sort of focus on the environmental aspects and the change in engine technology in particular. So, there has been a higher degree of new builds being placed and orders being placed over the last, 6 to 9 months, which again, sort of, creates opportunities for providers of financing. And, some people will issue equity and some will use the bond markets, but others would like ourselves and SFL to provide, and secure long-term financing. We seek long-term financing in the Asian markets, 10 to 12 years money, as well as some of the owners that we do business with. They would like to have that certainty when they do their modeling and when they place their orders to, avoid having a situation where they need to refinance their bank debt after 5 years and find themselves in a market where banks are rather exiting than willing to continue that relationship.
Christian, what trends are you seeing in the market right now?
No, I mean, I agree with Nicolas on the fact that the banks have absolutely become more active, and we see that also on call it the medium-sized owners. But at the same time, for many of these owners, some of them are used to, they have had one local bank, for example, that they have talked to for many years, and that bank is not longer there. They don't have the same sort of differentiation in their capital structure, and the bond market is not open to them. So for owners, smaller to medium owners, I would definitely say that the need for alternative financing is absolutely there. And at the same time, you have banks, being pretty strict on age restrictions and things like that, where you have alternative lenders being much more flexible when it comes to profiles and the age of the vessels, etc. And of course, as Jan Wilhelm said, the potential for higher leverage is definitely there in alternative financing compared to what the banks can offer. So I definitely think that there's still a big need for alternative financing out there, especially for the smaller to medium owners.
So kind of continuing with that thought, where is it most appropriate for this alternative finance to fit on the capital structure, of these companies, especially in the small and medium companies? Alternative finance has often been, in addition to traditional finance, But how could it really work with traditional finance and sort of complement bank financing? You know, how should companies be thinking about entering into new alternative financing arrangements? You know, and under what circumstances is the higher cost and higher leverage sort of justified, you know, to take on these new financing arrangements? Nicolas, I'll pose that to you.
Yeah, I think it's a very interesting question. And I think it totally depends on what your alternatives are and how many alternatives you have. If you are a sort of tier one large owner with access to all kinds of traditional lenders and capital markets, etc., then I would probably say that what you do is use the traditional lenders for all the assets that they prefer to finance, where they can sharpen their pencils the most. So, you know, typically your dual fuel Newcastle Maxes or large container carriers, whatever, you know, where they'll be throwing money after you and competing on margins. And then I'd probably use alternative finance in the sort of more marginal business. So smaller assets, older assets, assets that the banks are not that keen to refinance, where they're not that focused. And I think that's kind of how I would do it there. And for smaller owners that don't have the same sort of large palette of alternatives, I think that you can find also within the alternative finance space, you know, everyone thinks that it necessarily means super high leverage leases from Japan or China. That's not necessarily the case. You know, you can find Taiwanese banks, small banks that are eager to lend you, you know, 60, 65% fairly conservative LTVs at fairly attractive margins, at least for people who don't have the Nordeas of this world throwing money after them at L plus 2%. And so I think that what's interesting with alternative finance is that it's such a fragmented and huge space that there really is a product and capital source for everyone seeking any kind of debt.
John William, do you have anything to add to that?
Yeah, I think he's right. I mean, one way to look at it is to do the ships that the banks really don't want to touch, or at least be very expensive, like Nicolas just said. But we also see medium or even to larger owners wanting to do more modern ships, because with the banks they can get 60, 65 max, whereas they could need 80 maybe, or even 90. And then we come into a role again, even on more modern tonnage. So, but again, this is not an A4 product. It can every deal is different, and it fulfills different needs every time. So it's a matter of structuring and the demand there and then for that specific owner.
So
I think there's another aspect.
Go ahead, Andreas.
I think that, you know, we come across owners that have, as Nicolas alluded to, have access to, you know, great financing from the Nordeas of the world, but still want to sort of maximize the leverage that they have on what they often refer to as their core fleet, i.e. fairly new vessels that is an integrated part of their fleet, and that they know they will own basically from the vessel is new until she's sold, either for scrap or for alternative use. And they want to sort of, you know, capitalize on equity either in those vessels already today, perhaps as a combination of, you know, the Nordeas of the world and common equity, and sort of, you know, take that equity out of the vessel if you want, and use that for either further growth or other purposes. Or they want to make sure that when they place sort of new build orders for those kind of core vessels, they want to make sure that, you know, they have a financing structure which is in place for as long as possible, i.e. 15 years or so. So then you basically have, you know, people trading off the conventional and often cheaper bank capital for a longer dated and higher levered financing. And you know, you can often say that some also use that to call it bootstrap their equity and use it as a tool enabling them to raise equity when the timing is right. And as we've known, the windows for raising equity in the shipping markets have been, fairly short. And there's many factors that need to sort of be aligned with asset prices and earnings and equity markets, all being sort of open and attractive at the same time for it to make sense for at least some of the smaller owners to print equity.
Aksel, as a diversified fleet owner, is there an optimal alternative financing transaction if there was one? If these guys were going to present to you some sort of structuring option, what would you find attractive in this environment today?
I think on refer to the gentleman on the panel today, I think when we look at alternative finance as a financing option, it's going to be Japan or China really, in terms of a JOLCO or a kind of Chinese traditional lease financing, which has kind of the cost of capital and tender that we can take advantage of really. And we have several JOLCOs, we have several lease facilities, and it's really complementary to our bank facility, in particular for transactions that have a longer dated tenor, where you can match the long dated charter with financing back to back.
Super. I want to shift gears a little bit here and talk about the investors that are, backing the alternative finance companies. We've seen a retreat to a certain extent of some of the private equity out of the equity of shipping companies. Shipping companies have always struggled to have long-only money come in, at the equity level. And so I wanted to get your sense for, basically who's investing in these projects? What are they focused on? What are you selling them on? What are they prioritizing in terms of, these sort of investments? Is it cash flows? Is it credit? Is it management? Who are the investors and what are they focused on, I guess is the question. Jan William, I guess we'll start with you.
All right. Yeah. First of all, we invest our own money to get aligned with the other investors. Then we have a group which has backed us from day one, which we call the friends and family type of investors, which are primarily Norwegian ship owner / shipping linked families and family offices. And on the back of that, we and our track record, we also raised money from institutional investors for the first time in 2016, and that's pension funds from the US and the UK. I think what they like with us is, of course, a good track record. Since we started, we have done some 50 ships and only had one hiccup. And we have delivered a very stable, good return in terms of IRR, and have a lot of focus on cash returns so that they get a decent yield. Last year, we paid out 15.5% based on committed funds. And it's the risk reward basically that they have, and also the privacy. I think they like that we are private and not all over the place for every deal we do, and tell them who are investing with us.
Nicolas?
Yeah, I think obviously it varies a bit for the type of lessor or capital provider, but we have seen, well, you're right in your comment that private equity has really been trying to exit shipping the last few years. I think the big exception would be in forming and funding alternative finance platforms. I don't know the exact number, but I can count probably at least 10 alternative finance platforms at least that are backed by some form of private equity firm. And some of them have been quite successful, others have not. I think the key point in providing alternative finance is cost of capital arbitrage. And if you don't have access to cheap back leverage, there is no cost of capital arbitrage. Some PE firms have succeeded in finding that back leverage and have managed to make it work. Others have not, and sort of just been sitting there with a platform that's never really growing. For the listed companies, obviously, it's all the institutional investors. But I really do think that companies like Ocean Yield and Ship Finance will start to see a return to their stocks by the generalist investors to a much higher degree, because the general interest and sentiment around shipping, also among the long onlys of this world, is really coming back. So, you know, I don't see any capital moving out of this space at all. I think there's going to be a lot of equity coming in, and hopefully not so much that it drives the access and availability to this kind of capital over the top and then collapses our industry. But I think that there's a lot of equity going to be coming in here from various sources.
Christian, do you have anything to add?
No, I think I agree with Nicolas on the fact that, you know, yes, the money is coming or funded by private equity companies or credit funds or the other types of pension funds, etc. And as Nicolas mentioned, I would say that the alternative lenders that are most active now are the ones who are able to keep the cost of capital down. They have also experienced, of course, the increasingly competition from banks and other sources. And some of them have been able to sort of formalize certain relationships with the different lenders, and in that sense have access to cheaper back capital, which again enables them to continue to have the return requirement that they have on the equity side, but at least for the users of alternative financing, the cost of capital has come down. So I think that's definitely an important way of what we've seen lately.
So just to shift gears a little bit, but to kind of stay on the investor theme, investors are hyper-focused on environmental, social, governance, especially the E part in the ESG. We are in the decarbonization era, and I guess folks don't generally like to give predictions as to what's going to happen in the future, so I'm going to kind of ask the question in a little bit of a different way, in that, you know, how do you think alternative finance sort of fits within the decarbonization agenda going forward? Are folks going to be able to finance older vessels, less efficient vessels, you know, going forward, or you know, or is this segment of the financing market going to need to further evolve, or are folks just really going to pay lip service to the decarbonization and socially responsible investing and still go after deals that they find profitable? Aksel, I'll start with you.
I think, you know, for the existing alternative capital providers who have a certain return hurdle, they've already shown that they're willing to invest in older assets compared to banks. You go to traditional banks, they will normally say that if it goes beyond 15 years, they're not inclined to lend to such a vessel. So I think that that's a policy that's becoming a standard in many banks. And with that also comes probably less fuel efficient, less greener assets. So in that respect, I believe alternative financing will play a greater role, also as more cheaper financing is coming in to finance the new vessels. So I think they absolutely have a role to play for that type of vessels. But of course, on the back end, they also have LPs that also start to have ESG concerns. So at the end of the day, if you have old vessels that do not have any eco features, life becomes challenging. Yeah.
Andreas, do you have anything to add to this?
Yeah, no, I think that, you know, the majority of the people on this call sort of saw the whole wave of eco vessels, and people, particularly on Wall Street, you know, went to private equity and they talked about eco revolution. And I think that Andreas Pauw at that point in time when they IPO'd, BW LPG said it, quite nicely. He said that, we don't believe in a revolution, we believe in a eco-evolution. And I think we'll see the same now when it comes to sort of, the environmental aspects of vessel types and engines, etc. This is sort of an evolving trend. And I think, as you say, it's hard to sit here for any of us really to predict what the future will bring. There will be change, and there will be, I think, ample opportunity for all of us. Some people will, focus on, call it the older vessel with, the older engine types, and also the, be able to price that risk and be able to sort of price into the way that they do the business. And then there will be, deals where you have the, call it the green stamp, where you're able to seek cheaper financing from, again, our sources of financing, and as such be more competitive. And I think that, a lot of interesting things can be read out of history, and looking at sort of the discussions now both with oil and also sort of older vessels. I think that looking at the tobacco industry probably is a good way of looking at how that industry was forecasted to a fast death really in the post 1999 or what have you. And guess what, people are still yielding decent returns in the tobacco industry, despite sort of all the criticism and the fact that we know now that it's not good for your health. But there's a market for all of these things. I think what we as ship owners and financing providers should definitely do, we should be able to stimulate all new type of initiatives, as long as we're not sort of jeopardizing the risk reward that we're seeing for more conventional vessels. At least from Ocean Yield's perspective, if we had two deals side by side, one had sort of a call it green stamp and one had a more sort of conventional engine type, we would always opt for the green and modern one. But that said, there's also risk involved in being the first mover, and as such you need to price that into your models.
Yeah, William.
Yeah, I fully agree what was said here. From our side, it's quite funny because all these ESG hot topics we have had in our bareboat charter contracts, all these clauses from day one. So we have had that focus, but it was not popular to talk about. But now we have an ESG policy, and it's all very shining and nice. I think all of us will be retired by the time the whole world fleet has been renewed with green features. And in the meantime, we have to make the most of it. In 2023, you have these energy efficiency indexes kicking in from IMO, and you have the Poseidon principles that we will try to follow as well. So I think going forward, yes, if we can have a nice vessel with green features and we have the same return or even lower return, yes, we would probably look very favorable at that. But we also have to be realistic and say that the world fleet is not there. It's going to be derated engines and slower speed, so that the emissions will, let's see, at least the E part of the ESG will come down, and I think that fleet will need to stay there, and it will be financed.
Nicolas, how does alternative finance fit into the decarbonization agenda going forward?
Well, in my view, like I said earlier, I think any kind of provider of alternative finance is really dependent on the cost of capital arbitrage and the lower cost back leverage that facilitates that. And as long as you have things like the Poseidon principle and banks really hammering hard on the E part, well, actually on all parts of ESG, but for the purpose of this discussion, the E, I think that's going to flow down through into the alternative finance providers, not just the big listed ones that are faced with more scrutiny, but also others. And for the ones who, put it this way, as long as you're dependent on the banks and they put pressure on you to not provide finance to vessels over a certain age or that don't fit certain criteria, and to have provisions in your lease agreements on scrapping and things like that. I think that the ones who will not be impacted by this will have to provide alternative finance at their cost of equity, and that's not a viable solution for anyone in this industry. You can never navigate through the cycles of the shipping industry with a cost of capital of 15% or 20%. That's just not feasible. So I think that things are going to change, but like Jan William and Andreas said, it's going to be a gradual shift and a evolution more than a revolution. So, you know, yeah, that's our view.
Christian, we have 1 minute left. So any closing thoughts?
No, I mean, I agree with what most of what's said. I mean, ESG is important to everyone. I mean, even us as an advisor. But I mean, shipping is still one of the most environmentally friendly ways of transport. So older vessels will still be needed. There are not enough new buildings to cover the need for transport today. And I definitely agree that these vessels will be financed by alternative lenders if needed.
Well, thank you very much. I want to thank all of our panelists today for a very insightful discussion. Nicolas, you do such a wonderful job of bringing all of us together with these panels and conferences, and hope to see everyone soon in person. Thank you very much.
Thank you, Keith, and thank you to everybody. Great panel and great discussion. Thank you again. And thank you for your support. Thank you.
Thank you.
Thank you.
Bye.
Bye.